Hey, blockchain buyers, please like and subscribe. It's time to really get serious about having wealth. Crypto wealth is going to come with paying some kind of tax. So you need to know if you can qualify for the capital gains tax. Please know that you will be taxed on the gains that you have. I really would encourage you to keep that in mind and see what tools you can use so that you're following the law and you're not going to jail for tax evasion. Just saying. Anyway, we're in Investopedia. And it says capital gains tax. What are capital gains taxes? A capital gains tax is a tax on the growth and value of investments incurred when individuals and corporations sell those investments. When the individuals and corporations sell those investments. When the assets are sold, the capital gains are referred to as having been realized. That's why I repeated myself, is because you're taxed when the asset is sold. So keep that in mind. The tax doesn't apply to unsold investments or unrealized capital gains. So stock shares that appreciate every year will not incur capital gains taxes until they are sold, no matter how long you happen to hold them. If your gains go up 1,000% and you don't take profit, you're not going to get taxed on the profit that you didn't cash out with. Just wanted to make that clear. Now we can go forward. Day traders and others taking advantage of the greater ease of trading online need to be aware that any profits that they make from buying and selling assets held less than a year are not just taxed, they're taxed at a higher rate. What we just read was, if you are holding on to your asset for over a year, you're going to be taxed at a different rate than someone who took profit in the same year of holding that asset. Those are the day traders and others that take advantage of the greater ease of trading online. They just need to be aware that any profits they make from buying and selling assets held less than a year are not just taxed, they're taxed at a higher rate. The U.S. capital gains tax only applies to profits from the sale of assets for more than a year, referred to as long-term capital gains. These rates are 0%, 15%, or 20%, depending on your tax bracket. Short-term capital gain tax applies to assets held for a year or less and are taxed as ordinary income. When you work and you earn money, then you're making an ordinary income. Keep in mind, that's why you get an income tax. This is not an income tax. We're talking about the capital gains tax. That's your money working for you. Your money doesn't get taxed the same way you get taxed. So why not use your money so that you get taxed less? Makes sense to me. Anyway, let's move forward. Taxable capital gains for the year are reduced by the amount of capital losses incurred in that year. A capital loss is when you sell an investment for less than you purchased it for. The total of long-term capital gains minus any capital losses is known as the net capital gain, which is the amount capital gains taxed are assessed on. Alright, now I'm sure it's starting to get a little cloudy. What does that mean? Here are the key takeaways. They figured that too. Here are the key takeaways that you need to remember. Capital gains tax is only paid on realized gains after the asset is sold, meaning you're not having a capital gains tax if you did not sell the asset. So if you buy a stock and it goes up in price and you don't sell it, you won't be taxed on it. And the same thing with cryptocurrency. Capital gains treatment only applies to capital assets such as stocks, bonds, jewelry, coin collections, and real estate property. Only assets, not people, not the income that you make. Just trying to make that clear. The IRS taxes all capital gains, but has different tax approaches for long-term gains versus short-term gains. Taxpayers can use strategies to offset capital gains with capital losses in order to lower their capital gains taxes. It's going to have a video here, and I don't want to get a copyright strike. I don't know. So I'm going to go straight to the chart to make it just as bold and simple and easy for us to understand. Tax rates for long-term capital gains are this. Filing status, 0%, 15%, and 20%. If you're single and you cash out for over $441,000, then you're gonna have to pay 20% capital gains tax on the money that you cashed out. So if you sell $2 million worth of cryptocurrency, then you will have 20% of $2 million, which is $400,000, because it's over this $441,450. Now, if you want to pay zero taxes on your capital gains, then all you need to do is only cash out up to $40,000. After you've held it for a year, you only need to cash out up to $40,000, and you'll have to pay zero capital gains tax on that. Now that's pretty. What if you're filing head of household? Then you'll want to pay zero taxes on that too. So you'll only cash out $53,600 or lower. And if you're married filing jointly, up to $80,000. Married filing separately, up to $40,000. That's pretty good. Something you need to know: when investing in crypto, you get large gains. You must keep in mind how you can structure your taking profits so that you pay the right amount. You don't want to skip taxes, and you don't want to move past that. You definitely want to get a real financial opinion from this, but you definitely want to know all of the options that you have. If I were you, I would screenshot this tax rates for long-term capital gains, or go to Investopedia and look it up yourself. It's there for you. And that's all I really wanted to point out. I wanted to point that out to you because you need to know what your options are. And I hope that it helps you. I hope you make a lot of money. And I'll see you on the next one.